Now let's take a look at the bigger picture. And McCabe's with us, CEO and partner, Curo Private Wealth. Thank you for being here. And let's start with the consumer since we're on it at this moment. I mean, it's really the resiliency of the consumer that has helped to prop up this economic picture overall. I mean, GDP has been holding on. Your thoughts?
Yeah, thanks for having me, Nicole, especially on such a busy week as you kicked off the show by saying we were really interested to see the consumer confidence data come out this morning because we think this is a key data point in understanding the trajectory of the U.S. consumer. And the reason that's important is because there has been more talk over the last month or so about the idea of a soft landing. And we think the only way we're going to be able to pull off a soft landing or not have a recession is with a continued strong consumer. And as Kevin was just reviewing the data, what a number we got this morning, highest number we've seen in 2 years, way higher than we expected. It absolutely confirms that we still have a strong and resilient consumer, which is not surprising when you have an unemployment number as low as we have, but that has not necessarily been the case all year from a consumer confidence standpoint.
And people are still expecting a recession. I mean, a lot of people still use the word recession in the next 6 to 12 months. They're still sort of waiting for it and expecting the Fed will cut. And I wonder, because the consumer is really driving everything, they're still shopping, they're still being selective, but they're shopping. In fact, we saw home prices on the rise 4 months in a row, so they're still out there and see demand there. The question really is how quickly can everything flip around and do a 180? The markets are doing great. People have, jobs. How quickly can everything turn around?
Well, we've seen before in the past, things are great until they're not great anymore. So I think that things could turn around quite quickly, but we are in the camp of folks who believe we'll probably still have a recession, but it looks like it's being pushed off. The bond market is still telling us we'll have a recession. The manufacturing data is also telling us we'll have a recession. So the stock market doesn't want to believe it, and the stock market is still very bullish. But we do think it's coming. It's just a matter of time. And it does take time for the increased interest rates that we've seen the Fed implement to trickle down in the economy. But things could turn around.
Right. All right. Let's get to how to play this, really. Some strategy underway. I mean, you actually said to move your cash, put it to work in core bonds. So what do you mean by that? Explain to folks.
Yeah, absolutely. So if you look at what the Bloomberg Aggregate Index returns about 12 months after the Fed stops increasing interest rates. So we can all agree we're probably at least close if we're not there after tomorrow's meeting. The average returns in the bond index have been positive 13% if you look a year out after the Fed stops increasing interest rates. So what we're starting to say to folks who have been using cash as a bond alternative is why not move some of that money into core bonds where you can get attractive yields still, but also the potential for price appreciation, because what we have in cash is attractive interest rates. And people have been excited about that because for so long we weren't getting paid any interest on our cash. But if you're looking at it from a bond alternative, you don't get the price appreciation in cash. So we're not saying to do this with your cash reserves, with your emergency funds. You need to keep those in secure cash. But for that money that you've been putting in money markets or high yield savings as a bond alternative, it may be time to consider that. The other area we're looking at now that the recession may be pushed off is the small cap space. Valuations are more attractive there, and they have not run up as much as we've seen in the large cap sector. So there could be more return potential in the small cap sector versus large caps moving forward.
Right. I mean, what do you think about earnings season thus far? I mean, of course, we're waiting on some of the big names like Microsoft and Google. And I know you find these small caps attractive because they have obviously more value in some cases. They're not as frothy. But what do you think about as earnings are coming in here for some of these big names that lead the way?
Yeah, it's a huge week for earnings, especially, as you said, for the tech sector. So it will be really interesting. We think it's too early to judge the earnings season quite yet. We've had about 26% of S&P 500 companies who have reported. Most of them have beat. We saw some interesting and unexpectedly positive earnings come out of banks, both big banks as well as regional banks for the most part, which was nice. But we've seen some mixed earnings in energy and some not so great earnings in the pharma space. So we do think it's still too early to judge, but the market seems to be looking at this earnings season so far as very much glass half full. So it'll be interesting to see. I know all eyes are on lots of the earnings that will come out this week.
Gold has been trickling a little higher, moving a little higher as we await the Fed. And are you ever interested in something like that, gold or silver?
We're not opposed to having it in our portfolio, in our models. We don't have a particular allocation to gold right now, but it is something as an investment committee that we consider. We really consider all areas of the market and try to put money to work where we think the most attractive opportunities are.
If the Fed is one more and done, are you concerned that inflation pops back up? Because the understanding is that the Fed would rather put us into recession than be blamed for higher inflation once again, and that, they just can't do one hike and be done, that, they will stay hawkish and do two more, like they said.
Yeah, our base case is probably for one more hike, but they certainly could do one more now and pause like they did in the last meeting. Based on what we've seen in inflation so far, especially in the product side of inflation, with those prices coming down as we got out of the pandemic and some of the supply chain issues that we faced, we're not overly concerned that inflation will start rearing its ugly head again in any substantial way. And if we did start to see inflation trickle up, we do very much expect that the Fed would come out and be aggressive. There are many Fed officials, or at least a handful, who are concerned about the fact that growth and hiring continues to be strong. And as you said earlier in the show, we're not at the 2% level that the Fed wants us to be at. So there are members of the Fed that we believe are not comfortable with the idea around stopping the interest rate increases. So we're very much in a wait and see pattern right now.
Right, and that graphic shows what I said. It's really not until 2025 that we get near those levels. Thank you so much, Ann McCabe. Thank you. Curo Private Wealth.
Thanks for having me, Nicole.
Nice to see you. Thanks.